Thank you.
Welcome to Financial and Estate Literacy. Our guest is going to be presenter is going to be Mark Wilson. Mark, good morning.
Hey, good morning. Good to be here.
Good. Just so you know, none of our presenters are paid to present. They're volunteers. Our purpose for financial and estate literacy is to present a safe environment for you to learn some of the things about money. And today, we've talked about, in week one, we kind of talked about taxes. In week two, we talked about the financial planning process, of the importance of your net worth, of knowing your goals and objectives, and reviewing your risk tolerance. In the third week, we talked a little bit about medical care planning, and there could be a possible huge cost for custodial care that we need to be aware of. Last week, we talked about the investment world and the fees and expenses that are associated with buying products from a broker. So today we're actually going to talk about investments. So Mark, why don't you pull up your Ask First form?
Absolutely.
And what's your educational background?
Yeah, so I have a bachelor's degree in computer science from UC Irvine, kind of an odd path to get to the financial planning industry, but one that I think actually helps me every day with the analytics and stuff that I do.
And looks like you've been in the financial planning world since 1997. And I think we all know what a CFP is, and that's probably the beginning credential for someone in the financial services industry. But I've never, I know you, but I've never seen, I don't think people understand what an APA is.
Yeah, and I'll double down on the CFP designation. Everyone can call themselves a financial advisor tomorrow without anything. You need more background to cut hair. But a CFP designation, I think, is a bare minimum. It's not easy. It's a 3-year education program and a hard test, but I'd say, make sure people that are doing planning have that designation. But to answer your question, accredited plan administrator, that comes from my former life when I was writing software and working in the pension world, doing 401k and defined pension administration kind of work.
And no relevant licenses, which is good, because you only need a license if you sell stuff.
Yeah, exactly. I think it's unusual for people to think you've been in this industry for how long and you don't have a single license.
Yeah.
And that's just because I've never sold an insurance policy, an annuity, commission-based products. So I've never needed any licenses for that.
You're a fiduciary full-time, so your only obligation is to the client. How do you charge for your services?
Yeah, again, I'll double down on this. It's amazing to me that there's people that would not be able to answer yes to this particular question, saying I would put my interest or put your interest before mine. It's crazy. People will not be able to answer that. I work with clients in 3 different ways. And so just off the very front is I'm no longer taking active clients, but the folks I work with in one of 3 ways. I do most fee-only advisors work as a percentage of assets. Many people call it AUM, assets under management. And typically you hand over money to manage, and the fee-only advisor will work with you to manage that money and hopefully do some planning work as well. And they charge between, on the low side, probably close to 0.8% as a starting rate, all the way to I've seen 1.5% being fairly common for some people as well. So I do that. I work that way very much like most fee-only advisors, but I also work with clients that don't have money yet. And they essentially pay me a monthly fee. It's around $350 a month for most of my clients. and as they're building their wealth. So they have complex situations, they have good cash flow, they need an advisor, but they don't have that money yet to hand over. So I work with them on a subscription basis. If you think about it, it's like working like with a personal trainer, but for your finances essentially.
You've been
And
in the you've been in the industry about 40 years, and you mentioned that you're not taking any new clients. If somebody, will you help somebody out and just review their situation by phone or in person, and then refer them to another financial fee-only advisor in the community?
yeah, absolutely. So um, this this industry, I don't think you can throw a dart and hit a good advisor. You need to have, there's only a handful of really good advice, even in the field only advisor space. Not everyone is amazing. So I have a list of about 7 or 8 folks that I could highly recommend. I'm happy to take a phone call, Zoom call, whatever, to take 15, 30 minutes with you, find out more about what you're looking for, and direct you to 2 different folks. I would, generally send you to 2 different folks to interview. And as Pete pointed out many times, it's important to have a good personality match as well as the technical and other things as well.
Okay, let's
The last way I'll mention is I do these 2-hour on-the-fly planning calls as well, or meetings where we can meet, just go over your stuff, and it's almost like a second opinion. And I charge $500 for those
okay.
meetings as well.
Um, who's your custodian?
Yeah, I work with Charles Schwab as my custodian.
Okay. Let's get into your outline, Mark.
Yeah.
Equity
Uh,
and fixed income investing. Finally.
Yeah, so as I point out before, this used to be broken out into 2 sessions, an hour and a half on equity investing, an hour and a half on fixed income investing. And I've taken a full hour and a half on just fixed income. Today, we're going to do it all in one. So if I'm talking quickly, apologize, but it's in some ways, this is like a highlights tour of what the main things I really want everyone to know about both equity and fixed income. What are we going to talk about today? We're going to talk about the basics of cash, fixed income, and equities. I'll use these terms, fixed income and bonds, interchangeably. So if you hear me say one or the other, just know that I'm talking about the same thing. And if I say equities or stocks, I'm talking about the same thing throughout the presentation. So just to equate those, I may not be consistent. We'll talk about the considerations for each of these asset types. These are different types of investments, and they have different characteristics. We'll talk about those. And then we'll talk about the fun part, putting it all together, and any thoughts there. But the timing is quick, so we'll be moving pretty quickly. Cash is the easiest one of the mix for us to be talking about. It's money, right? My 5-year-old, when my kids were 5, they really understood the value of money. I give them a quarter, and they know that they could go buy something with that quarter. Cash it's very safe, it's protected, and in some cases, it actually pays you some interest. The other thing is it's liquid, right? You can get the money out when you put it in and get it back. You're not worried about the price being different at all when you take it out. That's the main difference with cash.
And as we get older, we need more liquidity.
Absolutely, absolutely. Things can go wrong. We talk about emergency funds for folks, and this is cash is that core asset class that you would use for emergencies. Whether it's I fell and broke my wrist, or my hot water heater isn't working. Cash is the place that you'd go. You wouldn't be pulling money out of the other asset classes. Where you'll find cash is, again, this is very simple stuff in your checking account, your savings account. Those are the money market accounts are essentially savings accounts within a brokerage account. But I lump in short-term CDs into the cash examples and US Treasury bills into these mix because they really can be used as a very short-term type item. They're not as liquid, they're not as easy to get the money out as the 3 top options, but you can you're not worried about your pricing being dramatically different if you needed money from those at the end.
Let's say you were with Schwab and you're investing in 1 year or less T-bills, what I believe they're paying today somewhere around 5%.
Yeah, north of five, just slightly above five today. A 1-year T-bill, which is the shortest term or one of the shorter term government bonds, is paying over 5% today. So
And
that's great.
so, so
And
how
T-bills
long?
are state
So,
tax free as well. They have the benefit of being state California tax free as well.
so how long, if I needed the money, would it be before I had that money accessible to me?
Yeah, so the nice thing about the T-bills is there's a very active market, and you could trade that T-bill in the market and get your cash out. It would be a longer process than a longer, more difficult process than certainly checking in savings accounts, but it's a good option. The nice thing today is high yield savings accounts, FDIC protected savings accounts today are paying north of five as well. So it's not like you have to use a T-bill to lock that in. The difference is if interest rates go down, that savings account will go down in yield, where a T-bill will stay fixed for that 5% or more for the next year or so. So for emergency funds, I would lean towards the top three options. But if you need something less than a year from now, the other two options are pretty good. The benefits of cash is safety. This is all about safety. This is the boring. This is the blocking and tackling of investments. You should have a stable price. These are often protected either through government protections like FDIC up to certain limits. It's liquid, right? When I need it, I don't have to worry too much about having far less when I actually need it. But the problem is that the returns average the inflation rate. So if you're getting paid 3% over time and inflation's 3% over time, you're not making any money. It's better than money under your mattress, but you're not really getting any buying power by having money in cash. So you don't want to have, if you can afford it, maybe you want to, but most people can't afford to have huge piles of cash on the side. And the long-term returns going back 90 years have averaged 3 to 4%. When I taught this 2 years ago, people were drilling over 3 to 4%, and today we could easily get 5%. But
How
that may
time, how
that might be
times have
three or four.
changed. Yeah.
Yeah, that might be three or four in the next couple of years. We don't know where interest rates will go. What is fixed income? What are bonds? These are loans. I mean, people overcomplicate this stuff. These are loans, right? You're handing money to a government, a person, a bank, a country, and you want to get that money back with a little bit more. You want some interest paid. These are so you typically would hand the money over, get some interest payments along the way, and then they give you the principal back at the end of whatever the loan period is, if all goes well. What are some examples of fixed income investments? Well, a lump longer term CDs. So a 5-year CD, a 10-year CD, I'd put in this example. US Treasuries, government overcomplicates. They don't just call them government bonds, they call them T-bills. They have bills, bonds, and notes. They break them into this different terminology. They're all the same thing in terms of you're loaning money to the US government. Some are 3 months, some are 1 year. The bonds and notes can be a 10-year or a 30-year time frame. The Going from top to bottom here, we're loaning the longer term CDs, we're loaning the money to the bank. And the bank is loaning it to someone else, but we're loaning the money to the bank, hoping they'll pay us back. US Treasuries, we're loaning it money to the US government. Municipal bonds, these are the tax-free muni bonds. We're loaning money to municipalities. We might be loaning it to California. We might be loaning it to a water district. We might be loaning it to a local municipality. So those are tax-free bonds. Corporate bonds, we're loaning money to corporations, IBM, Meta, Apple, the local mom and pop yogurt shop. Mortgage-backed bonds, we're loaning money to people to buy properties. It could be a commercial property, could be a home, could be a condo. And international bonds, we're loaning money to different countries. It might be Japan, it might be Tanzania. So you have to be careful across the board where you're loaning the money to. From top to bottom, you can see the difference in risk. We're loaning money to banks with FDIC protection. We're loaning money to the government. The US government is, they can print money, so they're not going to default on their debt. But as we move down the list, it gets more and more likely we may not get our money back. So we should have higher interest rates near the bottom here than at the top. So that's one of the main things is that there's a risk and reward even within the fixed income type world as well. It's a big difference. I'm not going to loan money to Tanzania and an international bond at 5% if I can get 5% in a guaranteed CD. So they need to pay me more to be able to entice me to loan them money. Benefits, the real big benefits here are really two. This dependable income. So we're getting some form of income, periodic payments. Most bonds pay twice a year, semi-annually, but some bonds pay monthly, some pay annual, and some actually don't even pay you any interest along the way. These are called zero coupon bonds. And in those cases, you're loaning someone maybe 90 cents and they give you $1 at the end of the period. So you're getting the interest built into the payment over time or without getting payments over time. Why do I want bonds? Well, they're going to earn higher returns than cash. And we're seeing that about 1.5% to 2% over time above the inflation rate. That's been the average rate. There's been much higher and much lower than that. And the long-term returns going back to the 70 or 90 years is 4.5% to 5.5% over time. Today, pretty safe bonds are paying higher than that, 5% to 6% today.
Talk a little bit about the complement to other investments.
Yeah, one of the best things about bonds is the downside protection. When stock market gets bumpy, typically bonds do well, but not always. So we can see a world where when stocks get beat up, bonds can be that ballast where they won't not only won't go down, but they'll go up in that environment because people are panicking and selling. They shouldn't be, but they're panicking and selling in the stock market and they go to safe stuff and they'll go buy bonds. So that's so typically we'll see interest rates or stock market drop. We'll see bond markets do well in that environment.
And so typically we'll see older individuals more heavily weighted in the fixed income area versus in the equities area.
Because of the dependable income, because of the safety,
Yeah.
and because they're much closer to needing that money. So the time frame is important for sure.
Yes.
And then we'll jump to what are stocks or equities. I'll start with what they're not. Everyone, when I talk about stocks, a lot of people just think they're horses, right? This is going to Vegas and gambling, or roulette numbers, or a lot of people just think it's just an EKG chart, EKG chart, just going up and down and up and down. And why would I want to invest in this kind of thing? But they're not. Equities are an ownership. You own a piece of a business. If you're thinking about this as horse racing or roulette numbers or EKG charts, you're not going to be a good stock investor. You need to think about it as I'm buying a piece of a business or pieces of many, many businesses. I'm a big fan of index fund investing. If I'm buying an index fund that invests in large company stocks, I might be having a piece of the 500 best or largest US companies in the country. And so it's important to think about it in terms of ownership rather than this just gambling ultimately. My daughter's friends came over the other day and they're trading stocks like at the dinner table, and then they're doing sports betting and exactly the same thing. That is not investing, that is gambling. That's the way they play it.
Yeah, I have a 92-year, well, I did have a 92-year-old client who, when I had to do their tax return for the previous years, and she had done $1.5 million worth of stock trading.
Yeah.
And
So
didn't come out a winner either.
no. Yeah, that's the shame of these these accessible platforms like Robinhood and so forth is I can buy and sell 50 times a day, and I'm probably not making a lot of money in that environment.
Yeah.
Uh, there are 20 million, essentially 20 million privately owned businesses. We're not able to get access to those privately owned businesses, but there's around 4,000 public businesses that are on stock exchanges that I can go and buy a share or 100 shares or larger chunks to own a piece of those businesses. So when I
Is
own
the
100 shares of Apple, I own a teeny tiny portion of the entire company of Apple. Might own two doorknobs, as I joke, but you own all of their future, a little piece of their future earnings. So if you think about it that way, I think it helps people invest a little differently.
Yeah. Would you compare the fixed income market and the equities market? Are they about the same size, or is there a disparity there?
Yeah, it's actually shocking. So when we look at the loaning versus owning, right, we see a huge difference. I don't remember the difference. I think it's around 10 times larger. The fixed income world is around 10 times larger. I could have that number wrong, but substantially larger than the equity world. And the reason for that is there's only one, so it's larger in size, but it's also larger in numbers. So when I say there's 4,000 public companies, there's essentially 4,000 tickers I can go out and buy of their stock. In the bond world, there's many multiple of that, and that's because they borrow money over and over and over again. There's only one Apple stock. I can only buy one version of that, but I might be able to buy 50 versions of Johnson and Johnson loans, a loan that they had 12 years ago, a loan they had 12 months ago. So there's actually many, a bit much bigger size in number of bonds as well, which complicates that world substantially. Just like there were different types of bonds when we talked about the CDs through the international bonds, there's different types of equities, and the terminology gets muddied pretty quickly, and I use it without thinking sometimes as well. But the breakdown is we break it down into different types of companies that you can invest in. And one of them is called large cap US stocks, for example. Those are large company US stocks. And those are companies where if you went out and bought the whole thing, it would cost you more than $10 billion. There's actually companies that today that are in the $1 trillion range in terms of the total. If you bought every single share of them, it would cost you more than $1 trillion to buy those companies. And examples of this are Tesla, Johnson and Johnson, and Amazon. If you think about a company, more than likely you're thinking about a US large cap stock.
S&P 500 would be a large cap.
Exactly. The S&P 500 invests in the 500 largest US stocks, essentially, and those are all large cap stock companies. And then we've got the Russell or the small cap stocks, small company stocks. We've got companies, I break it down to under 2 billion if you were to buy the entire company. And these are different companies, Avis, a Tenet Healthcare, a Macy's. And you can understand the difference between it's much more likely that a small cap company, a small company stock, is going to have different struggles than a large company stock. It's hard to imagine an Amazon struggling financially next Thursday. But as we saw this week, what was it? One of the companies, Red Lobster this week was declared bankruptcy. So we see a small cap stock that can really struggle and go away. So there's different issues there, certainly different issues worldwide. Avis doesn't really care what's going on in the supply chain around the world. They're just going to rent you cars. So they have different issues for sure. And then we jump to there's companies outside of the US, and you can invest in those as well. So you can invest in companies that are domiciled in Japan or the UK and Switzerland. And there's great companies outside of the United States, and people should pay attention and have a little bit of those in their portfolio. And then we even have companies that are domiciled in China and India and South Korea. And those are also interesting as well. The same idea as I had on the fixed income list is risk, it goes up. The risk of Amazon struggling and going bankrupt next Thursday is very small. So these are the safer companies at the top. And then as we move down the list, we see more and more risks. There's certainly a lot more risk investing in a company in China than there is in investing in Tesla, for example.
You know, so individuals, if they look at their own portfolio, need to kind of classify what they own. I think most people don't really realize what they have, but this is the terminology that they should use. So they should put a percentage. How much large cap US stocks do I own in my own portfolio? How many do I have in small cap? How much do I have in developed international or and an emerging, so that they can get an idea how well they're diversified.
Exactly.
To comment on the importance of diversification.
Yeah, it's the most important thing. Some of the great academics have said it's the only free lunch of investing, right? It's the only really that's the big item of investing is to be diversified. So it's very difficult for people to we see people that make money on non-diversification, the Tesla millionaires or whatever that might be, but it's very hard to stay rich. And we're only seeing the best of those. We're not seeing all the thousands of companies that where the owners failed. But owning a little bit of everything, and we'll see this in the last couple the last part of the presentation is going to be the best thing. And you're just removing risk. There's having a little bit of everything takes away and makes the ride that much better.
So when we talk about fixed income and we talk about equities, how much should we have of each in our portfolio, or is there a magic formula?
So that each person really needs to think about and do and come up with that. That's the $64 million question here, is to figure out what's the right mix for you. And I use three different ways of figuring that out. So a typical tool is to just ask you questions about your risk profile. And they ask questions like, do you ride a skateboard without a helmet on? And they determine, oh, if you take these risk behaviors, therefore you're a 80-20 investor, meaning 80% in stocks and 20% in bonds. I think that's silly to just ask about your risk. I shared this story when Pete and I were speaking this week. I had a client a long time ago who was actually she was a mountain climber, would climb mountains, no ropes, like on Yosemite, and she had the highest life risk tolerance I've ever known, but she could not take bumpiness in her stuff. She lost 1%, she panicked and sold. So your life risk tolerance and your financial risk tolerance are two different questions. But you also have to ask the question about how much can I afford to lose? If the markets go down 10% and they go back up 10% a year later, is that a problem for me? If you're living on the money, that is a problem for you. If you're just saving, 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 and you're still in your working years, it's not such a big deal.
Yeah.
And you
So
also have to ask, what's the need for risk? If I stuck it all under my mattress, do I have enough to live the rest of my life? Or do I need to stay ahead of inflation? And those three things put together I think, are the best way to figure out how much is in stocks, how much is in bonds.
yeah. So asset allocation and diversification are two huge issues, but you don't know what they are unless you look at your own portfolio and, see what you have.
Yeah.
And you should,
And if the average person goes out and buys a bunch of stocks or buys a bunch of index funds, they own mostly this stuff, the large cap US
yeah,
stocks. Probably own very little or none of this, very little or none of this. And we'll talk about a little bit why you want to own some of those areas
let's
as
go to
well.
the next slide.
So not only do we break the world into large, small, international, emerging markets, it actually gets split even finer tuned than there. There's also this idea that there's two different types of investing approaches, equity style approaches. And one is called growth stocks, growth investing, and one is called value investing. Growth investing is investing in the fun stuff. These are the companies that are doing well, they're growing fast, they're the exciting companies. Apple, Microsoft, Amazon, Tesla, Google. These are the innovators and so forth. But everyone knows they're the innovators. Everyone knows they're the leaders. And then there's the value stocks. These are boring, out of favor companies, and we might lump in there J.P. Morgan, Berkshire Hathaway, which is Warren Buffett's company, Johnson and Johnson, Exxon. These aren't going to create the new AI that changes our world, or the new device that we can talk to that does all these miracle things. But they're there. It's important to understand these two different investment styles, because they also go in and out of favor. There's times when investing in the fun stuff does really well, and there's times where investing in the boring stuff does really well. What did Warren Buffett make all his money on? He made virtually all his money on these value stocks. So he's invested in, railroads, and in chocolate companies, and in soda companies. He's also
These,
investing in Apple more recently as well.
yeah,
So we'll give him a little credit there, but the bulk of his net worth is in the boring stuff. But he bought those when they were out of favor and just waited till they were in favor again. And I give the example of the storefront. You walk by the storefront, if there's a purse in the front storefront, or it's the blingy, beautiful, expensive purse. And if you walk to the back of the store, in the bargain rack, there's a half price purse in the back. Well, in the front is the growth purse, and the back is the value purse, in the way you can think about it. And then there's times where you want to own one and own the other. Owning a little of both is the way to go. Again, diversification. And we should have the diversification stamp on every single slide here. Why do we own these equities? It's all about long-term growth. It's not about short-term growth. It's about long-term growth. And they've averaged, US or the stocks around the world have averaged 6 to 7% above inflation. We need to stay ahead of inflation, is a really important thing. A 65-year-old retiree still has 25, 35 years to worry about. Inflation can eat into those numbers over time. And long-term average returns have averaged 9 to 10%. Again, long-term average returns. Equities are inflation protected often. So when inflation goes up, companies tend to do well in those environments. So actually stocks tend to do well in the long run when inflation is spiking. And stocks and equities can be tax efficient. If a bond's paying you an interest payment, that's at your highest marginal tax rate, at your highest tax rate. Stocks are actually taxed at a capital gains rate if you hold them for more than a year, and that could be half as much or even 0%, depending on what your income is as well. Let's talk about just kind of comparing these. And so this is a classic chart in our industry, looking back to all the way to the Depression, and how did all of these things do over time. And so here we can see that inflation over this 90-year period, if I'm doing the math right, has averaged 3%. We know it's been as high as, recently in the high single digits. It was also close to zero for years and years.
yeah. I remember 18% interest.
You're dating yourself, Pete, but you're right. It has been super high. Cash over that period of time has averaged 3.3%. So just barely ahead of inflation. You're hardly better than sticking it under, or just ahead, you're not buying much more than you started with. Real estate, this surprised a lot of people, going back to the Depression era, has averaged only 4.2%. So most people think real estate's by far the best investment, but actually over very, very long periods, it's done in between cash and US stocks. Government bonds, these are 10-year government bonds on average, have averaged 4.6% over time, and US stocks have averaged that almost 10% that we mentioned. You can see so it's important to understand the differences here, but it's also important to see how these charts apply over time. We see the US stock drop here during the Depression. We see it here during the inflation spike of the 70s. We see it dropping here during the tech boom wreck. We see it drop here during the global financial crisis. These don't look like a big deal. This is a 75, 80% drop, 50% drop, 50% drop, 50% drop. We see a 35% drop here with the COVID decline. So you have to have a strong stomach to get the types of returns in stocks. Where we see bonds, the green area, it's not that bumpy. There aren't that many big drops in the market. We actually see one of the biggest ones more recently. And then we see things like cash where we don't even see drops at all. It just does its boring stuff over long periods of time. If someone asks me, well, how am I going to do in stocks over the next 5 years or bonds in the next 5 years? I can tell you very confidently that you'll be in between, roughly a 28% and a minus 12% over time. I cannot tell you with any accuracy that you're just going to double your money every 5 years. It's
Well,
really
Mark, if you can't tell us that, what are you doing here presenting?
yeah. My wizard hat. I left my wizard hat in my other
Can
office.
anyone do? You know,
Well, there are TV stations and newsletters full of people that will tell you they can tell you these things, but
yeah,
the reality is, Jack Bogle, who ran Vanguard, who started Vanguard, they called him Saint Jack. He was such a good investment. He said, I've never met a market timer that made money, but I've never met a person who's met a person that made money getting in and out of the market. So it's really important here.
yeah.
So with having this understanding that I don't know within any 5 year period, these aren't 1 year periods, these are 5 year periods where you can make a lot of money or lose a lot of money in the stock market. It's really important to understand that, because when those bad times comes, then you just say, well, I knew this was coming. I'll go rebalance and buy a little bit more when things are struggling here. We can see bonds, there's 5 year periods where you lose money in bonds, but for the most part, you're making money. No 5 year periods where you lost money in stocks. And actually, there's 5 year periods where you lost money in real estate, but the returns are in between these as well. So just understand that these are very volatile, and we'll see more of that as well. But comparing the volatility, and the key thing is put these all together to end up with something that has a much different ride at the end of the day. We'll jump into kind of the three highlights of things that I want you to know about fixed income. And the first one is this concept of when interest rates rise or fall, what does that do to your bond pricing, to the actual price of your bond? And it's an inverse relationship. When interest rates rise, bond prices fall, and the opposite, when interest rates fall, bond prices rise. This is a chart of 10-year interest rates of the US government bonds, what the yield, what you were going to get if you bought a bond in 1960. You were buying a 4%, a bond that was paying you 4% over the next 10 years. And interest rates went up and up and up. Most people have long forgotten this period, but we see interest rates going from 4% all the way up to the 16% range. During this time frame, it was a terrible time to be a bond investor. Bond prices were beaten up over this period of time. But for the last, 50 years now, 40 years now, have seen interest rates fall almost exclusively. We've seen this spike here more recently, but when interest rates are falling, bond prices are rising. So it's been a great time, 40-year great time to be a bond investor, because those bond prices are going up as interest rates are going down. So why is this dynamic? And why does this happen? Is imagine that you go into the bank and you buy a 5 year CD and they're paying you 4%. And then tomorrow you find out that they're now paying you 5%. So the interest rate has gone up over that period of time. You're not very happy that you own a 4% bond for the next 5 years, or 4% CD for the next 4 years, when your neighbor can go in and buy a 5% CD the following day. So I can hold on to it and earn the 4% for the next 5 years. Or if I say, I want to go sell this, if I went out in the market to go sell that, no one wants my 4% bond. Everyone's getting them at 5. So what do I have to do? I have to lower the price to entice someone to do that. So that's the dynamic. And the opposite is true. If I bought a 5% CD and now rates are 3%, everyone wants my 5% CD, so they're willing to pay me more for it. So that's the pricing aspect of bonds, why the dynamic there.
It's difficult to grasp, put your head around thinking that as interest rates fall, that bond prices actually go up. It's just, you have to kind of steady yourself and go through that kind of explanation that you made to fully understand it. So, what in, we're not going to get into too much of this, but bond pricing is based on maturity and credit risk and everything else. But one of the most important things is duration. How long a period of time before the bond actually is fully paid off?
Yeah.
What in your client's portfolio, what is that magic range that you keep your clients in today?
Yeah, so I'm not a fan of buying long-term, like 30-year, really long-term bonds. And because I don't think the risk, the extra risk that you're taking, you're paid for that. I don't think you're paid for that extra risk. If I can buy a 30-year bond at 5%, at today, 4.1% range or somewhere around there, why am I, and I can buy a 10-year bond at the same range, why am I taking that extra risk? Why am I locking my money up for that extra time period? So, but to answer your question, I'm most of my bonds are averaging between 5 and 7 year type duration, and which is in the middle ground. And then we would call those intermediate term bonds for the most part. But that's made up of some shorts, a medium, it's made up of a little bit. Again, diversification, put that stamp on the screen, diversification stamp.
Yeah.
You want to
So,
diversify against timeframes as well.
yeah. So if you own a bond fund, it behooves you to take a look at it and see what the average maturity is in that bond fund. Uh,
Exactly.
so that you understand the risk that you're taking. The longer the maturity date, the greater risk. And I know you're going to talk about this slide just a little bit, but just wanted to get that emphasis in on examining what you have so you understand the risk that you're taking.
Yeah, exactly. So that longer term, I'll jump a slide ahead or so. The longer term means more risk. So again, if I'm going back to my example, the person that bought the bond at 30-year bond, and next week the interest rates are higher, they're stuck with that lower return for 29 more years. So the price goes down substantially. If I buy a 1-year CD and prices change, I just hold on for a year so my prices don't change substantially. And we can see in 2022, the beginning of 2022, we saw these were interest rates at that time. It's actually hard. It's crazy that it's hard to remember that 2-year CDs, 5-year government bonds, and so forth were paying. These were the interest rates we were getting at the beginning of the year. So at the beginning of the year, you bought a 2-year CD, you're getting 0.7%. At the end of the year, you were getting 4.4%. That's how much interest rates moved. And what happened to the price? And this is actually the total return, but what happened to the price? It went down 4%. We went in 5-year bonds from 1.2 to almost 4. Those dropped, the price dropped 9%. And that's because, again, these are longer maturity. 10-year lost 1.5 to almost 4. We lost 16% in price. And the 30-year, we lost 30%, or somebody lost, I didn't, but somebody who owned these 30-year bonds lost a third of their money. Now they can just hold this bond for the rest of the time of the 29 years and earn 1.9 over that period of time. But if they were to sell that bond that day, at the end of the year, they lost 30%. The bond market in general, when we put it all together, went from 1.75 to 4.6, and the bond market had one of the very worst years in history with a minus 13% return. So again, that longer term means more risk. So you're locking it in. The flip side's true as well, is if rates go down, these could be positive numbers on this side. So it's something to be, but we've seen the positive version of that as rates went down and down and down. Who knows where the direction is from here? Jumping back to the other point I want to make about bonds is they're steady. we'll talk about 2022 being an outlier, but they're steady. This particular chart is showing us the actual returns of the bond market each year. So for example, in 1976, the bond market was up 16%. In 1977 is up 3%, and you get the idea. And back last year it was up 6%. 2022, we see a big drop. The point of this chart really is you can see the types of, most of these are up years, right? We see up year, up year, up year, up year, a little tiny down year, a little tiny down year, a little tiny down year. And before the 2022, we see a little tiny down year. So most years are good. You're not going to be beaten up too much in bonds. 43 of the last 48 years have averaged, have been up years. We can see the returns are pretty steady. They're not really high, they're not really low. And these little red dots at the bottom shows you if you got in and out, in at the highest part of the year and out at the lowest part of the year in the bond market, how much did you lose? So if you're that panic person, how much could you have lost? There's not that many big numbers here. We see a lot of ones and twos as we go across the bar. Every once in a while, you can lose 7% or 9%. More recently, we see 2022 where we saw the market just got hammered. What happened in 2022? This is what happened. Rates went from, the 10-year rate went from here to here, right? So we talk about that inverse relationship. Interest rates went up, prices went down, and we see that here, the minus 13% bond market return year there. Do I expect to see this again? No, I don't. We haven't seen it for a long time. Rates where we started at ultra low rates and we jumped up in relation a mile. So to go from essentially 1 to 5 is a big jump. To get another 13% decline, now that interest rates are 5, we would probably have to see rates to get into the 11 and 12% range, which is just hard to imagine. It could happen, but it's hard to imagine.
Was this the year we were having COVID? The government was putting an immense amount of money into the economy.
Actually, the opposite. Yeah. So in COVID, when they're putting money in, it's actually making interest rates go down. So they were actually trying to juice the economy. So they were pumping money in and making interest rates go down. This is the period where the Fed is trying to kill inflation. They're trying to kill inflation, so they're raising interest rates to kill inflation. And they seem to have done a good job there. But it's all about, it was that the economy was slowed or was going too fast, and they had to raise interest rates to beat up inflation.
Slow it down.
Exactly. I think we covered this pretty well in
Yeah.
terms of longer term means more risk. I'll highlight this. So a lot of people will use things other than bonds to try to get the same kind of safety and income exposure. I would say there's no substitute for bonds in a portfolio. They're not exciting, but they're there for a reason. And I cherry picked a year here, but a lot of people would, instead of buying bonds, they might go buy dividend paying stocks. So buy a Johnson & Johnson that's paying a quarterly dividend. They might be buying high yield bonds, energy partnerships, real estate investment trusts are popular, or commodities. And to show you, again, I've cherry picked a bad year, but in a year, this was during the global financial crisis, stocks were down big, bonds were actually up in that year. That's that counter cyclical time period where stocks are down, but bonds are doing well in that world. Dividend paying stocks were beaten up, bonds were beaten, high yield bonds, junk bonds were beaten up, MLPs were beaten up, REITs were beaten up, commodities. So to equate these with bonds, I think is a big mistake. You have to have some portion of bonds in your portfolio. Equity investing. So what are the things that I really want you to know about investing in equities? This chart is very different looking than the bond chart. So the bond chart, we saw 43 out of 48 years were up years. Here we see the differences here between the ups and downs, right? This looks a little bit like an EKG chart, but remember, we're investing in pieces of companies here. So only 33 out of the last 44 years have seen an up year in the stock market. So a fourth of every single year, historically, you lose money from the beginning of the year to the end of the year. If you don't understand that, you're always going to be buying at the wrong time and selling at the wrong time. The other thing to note, the difference here is these numbers are much bigger than the numbers that we saw in the bond. We saw up years of 3 and 5 and 7 and 9, but not 34s and 30s and so forth. But we also didn't see too many really heavy down years. Most are ones and twos. Here we can see what the stock market can do. Minus 10, 3 years in a row, minus 10, 13, 23, global financial crisis, minus 38, and so forth. This happens to be the same period where stocks got beaten up, or bonds got beaten up that year, and stocks got beaten up that year. So this is a very unusual time in 2022. The other point I want to make is that we talk about stocks averaging 10% a year, but does that mean that we get 10% in any one year? No. If we look across this, how many years are within a little bit of 10% return? We had to go all the way from 80 to 05, 04 to see even one year that was hardly even close to 10%. And we see a 10% here. This is the first quarter of this year, so that's not a full year. Very few years are averaging 10%. So they say you can drown in a lake that averages 5 feet in depth, because there's parts of the lake that are 20 feet deep. And so understanding that there's averages are very deceptive in the stock world, and you have to live through these. Feast or famine is really more so the way it is. And no one knows when the feast years are coming, and no one knows where the famine years are coming.
Yeah, but as we get older, we don't have that time period to wait for the good times in the market. And so therefore, we like less volatility. So usually as we get older, we have more in fixed income.
Exactly. And really is, if you're a 65-year-old, there is a piece of your portfolio that you're going to need when you're 85 and 95 years old. That part can be in the stock market, assuming you have the stomach to live through the bumpiness along the way.
Yeah, we need some inflation protection,
Exactly.
because we're living longer, so some of the old formulas based on, on age doesn't really apply, I think, today as well as it did before. We really need to look at our own situation. How long do you have your clients live till, Mark?
Yeah, so my 65-year-old client, I would run numbers out to 95. You encouraged me to bump that to 100 when we spoke this week, but I'm using 95 as a life expectancy on the long end, and but I've got clients that are in their 90s. I'm not using 95 for them. Obviously, we need to think about that as well.
Yeah, and it's about number crunching. So much is not about trying to pick the right stock, or it's what kind of. I've heard, and you correct me if I'm wrong, Mark, that the performance or the return that you get from a portfolio is not dependent on the stock you pick.
Right. So the key part is being invested in stocks, and
In general,
the more diversified you are, the safer the safer stocks are as well. But you're right, it's not everyone thinks it's about the individual stocks you pick. It's really about how much is in stocks and how much is in bonds. That drives 95% of all of your long-term returns. It's not Coke or Pepsi. Whether I bought Coke or Pepsi, that makes the big difference.
yeah. Even Warren Buffett will tell you that the index funds are the way to go for us ordinary consumers.
Exactly. One of the beauties of Warren is he doesn't tell you, he tells you how he did it, but he doesn't tell you that you can do it as well. So that's the big difference, or everyone else is selling you something. And he's in many cases saying, don't even try to do what I'm doing. And then, you got to live a long time as well and have, make really good calls a long time. I'll point out the last part here, and this is another really big point, is these red dots, if you remember those red dots on the bond slide, you saw minus ones and twos for the most part, and then every once in a while, a -7 or a -13. Here, we see this very consistently. So if you are the best invested at the high in 1980 in the stock market and sold at the low point in 1980, you lost 17%. In a year where the market was up 26%, there was a scary part where we saw a 17% decline. And the average decline in any year is 14.2%. So if every time the market drops, you panic and get out, you should never own stocks. You
Yeah.
just really have to have a stomach to be able to do it, or have someone hold your hand through this time period. So a lot of what I do is build a portfolio where I can hold someone's hands through these scary times, because they're coming every 4 years, every 10 years, we're going to see really, really scary times.
And we're much more susceptible to negative news. Uh,
100%. Yeah,
you know,
absolutely.
I think that they say that negative news is 5 times more memorable than good news. And so it has an emotional impact on us. And so stop watching TV.
Yeah, and what sells? What do news programs sell? The negative, right? They might have the 1 second little really feel good moment at the end where it shows you the little girl that saved the puppy, but the rest of it is trying to make you scared and
Yes.
watch the program.
Eyeballs on the screen is how advertisers have to pay. And so the scarier they can make our news, the more likely we're going to be watching.
Yeah,
So,
yeah. Stephen Forbes, who is associated with Forbes magazine, the financial magazine, says you make more money selling financial advice than following their financial advice. So don't even he's picking on himself, saying that you don't always their advice isn't always good advice.
yeah, let's go to the next slide.
Following your gut is dangerous. So this particular chart is a chart of consumer confidence going back to the 70s. And they asked folks, how are you feeling about the next year in the economy and your life and so forth? And we see that people are sometimes pretty happy about things and sometimes pretty upset about things, and happy and upset and happy and upset. And we can see that in the 70s, after this big long recession, um, this was the big inflation spike in the 70s and the recession that followed it in 75. People were pretty depressed at that period of time. And then we see times during this is when the internet boom and everyone was making money in internet stocks. We see people are pretty happy at that time. So happy and upset. If you're investing at these high times, all the good times, when people say things are great going forward, rah, 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 what was your average return for the next 12 months? 3.5%. So in other words, when I invested here, let's say in January of 2000, when everything was exciting, the next year we earned 2%. And so sometimes we make a little bit of money, sometimes we lose a little bit of money, but on average, we're not doing very well when people are feeling good about things. On the flip side, when people are feeling miserable about things after the long recession, after the 80s recession, 90s recession, we see here the global financial crisis, we see COVID here, we see more recently what was going on with all the interest rate spikes, and so as an inflation spike here. Um, how did you do if invested when you were sick to your stomach about the next 12 months? Plus 24.1%. Now, no guarantees here at all, certainly no guarantees. And no one knows where the bottom of these when people are upset until we look back. But the really big thing is when you're feeling pretty sick to your stomach about things going forward, it's probably a good time to be investing. And when you're feeling good about things, it's the bad time. So I'm this guy that's always the opposite. I'm in opposite world. And when 6 clients call me saying, "Oh my gosh, I'm so scared, it's bad," I'm silently fist pumping. And when they're saying, oh my gosh, I'm so excited, let's put more money in the stock market, I'm wincing behind the scenes. So do the opposite of whatever your gut is. Where are we today? Pretty much in the middle. So I don't think there's any big opportunities plus or minus. And again, these are no guarantees here. We had no idea whether this was going to be great or not, but we can see that as well. This is the COVID decline. After that COVID hit, if you invested after that big decline in COVID, you made that was a very big time, but you had to have a very strong stomach to be able to invest at that time. We who knows what the world was going to go from there.
Behavioral finance is a field that's come into its own in the last, I would say, maybe 15, 20 years. And Conaham has done an amazing amount of research in this area, and so have many others. But the bottom line of all of those books say, don't listen to your gut, and even your mind. Don't listen to your mind, even,
Yeah,
that the mind plays tricks, and
right.
you can't absorb all of the information, and looking back is not always the best. And so stick to the basics is kind of
Exactly.
where, uh understand bonds, understand stocks, keep it simple, stupid. You're going to do so much better in the long run.
Yeah, yeah, exactly. And this is an example of the what happens when people jump in and out of the markets. And going back to your, so Danny Kahneman is the founder of, one of the main people in behavioral finance, actually won a Nobel Prize in economics. He's a psychologist and he won a Nobel Prize in economics based on his work there. So super powerful. But even Danny says, I have these same biases. I still do the dumb things, right? So understanding and trying to stop yourself from doing those things. Jumping in and out of the markets is the worst. That's what gets people in trouble. One of my favorite quotes is from Jane Bryant Quinn, who says, the market timing hall of fame is an empty room. And we don't see if market timing worked, if people can get in and out of the markets and make money in that environment, we would see those people in the Forbes 500 list. We don't see people like that. We see the Warren Buffetts and the people that are using long-term investment approaches or building companies is who we see there primarily. This chart is showing the returns of the different asset classes broken down a little bit. This is from 2001 to 2020. And we see that if you invested in any one of these, you did pretty well. And if you invested 60% in stocks and 40% in bonds, a 60-40 portfolio, you earned 6.4% over that 20-year period. The average investor lost 2.9%. And it's crazy to think that they could have invested in any one of these and just rode it out and made more money. The only thing they could have done worse in is commodities and cash. Why the difference here? Why is a 60-40 investor making double the return, more than double the return of the average investor? Because they're getting in late and they're getting in at the wrong times and getting out at the wrong times. They're
Emotions.
all behavior. They call this that difference, that 3% difference here, they call it the behavior gap.
Yeah.
And if we can close the behavior gap through all the things Pete was saying earlier, we can close that by having a long-term approach and living through volatility and all of that. Just that alone is you're going to earn double the return over 20 years. The difference between a 6% return and a 3% return is miles.
This is,
Miles.
Mark, this is why I don't manage my own money. I know a lot about it, but I'm way too emotional. And I think I'm at one time thought I was smarter than the market, and no longer. I've done much better. Uh, I have, my own fee only advisors, and it's that whole lack of trading, staying steady, not doing anything wild, not following stock tips from cocktail parties. It's you,
It's not as fun. I'll admit it is not as fun, right?
it,
Watching the financial news is exciting to see a guy on the screen saying buy, sell, do this, and jumping up and down. And if you saw Jack Bogle, who's again the founder of indexing, he would have a 1 minute show every Monday, say, do the same, and then that would be done, right? And the other, and no one would watch it.
Yeah.
And but that's the best advice ultimately.
Yeah.
I'll make a quick pitch for international stocks. So most people are underweighted in international stocks. And so this is a chart showing that the purple is when international companies are doing better. And the gray is when US companies are doing better. And we see periods where international is outperforming, then US, then international, then US, then a wide swing of international doing way better, US, and so forth. We're only remembering here and only seeing US stocks have been on the best place to be for the last 15 years. More recently, we're seeing maybe we'll know in 10 years, but maybe we're seeing a turnaround here. And there's lots of hints to say that international stocks are priced more um, um, interestingly than US stocks are today. So I'm a fan to have at least some portion of your stocks outside of the US, and I think you'll benefit from there.
What percentage of a portfolio of your equities portfolio is typically what you're recommending or you're putting your clients in today?
Yeah. So I like international stocks. So I would say if a person had 60% in stocks and 40% in bonds, which is not totally atypical, that I would have roughly 20% of that, 20% of the 60 in international stocks, maybe even a little more than that. Yeah. So
Okay, and then
30%,
that's
roughly
part
30% of the equities. Yeah.
in the developed countries, and how much would you have it in emerging?
Yeah, so I probably, and again, everything depends on the client age and all the other
Yeah.
factors, but in general, I would have roughly, we'll call it 25 in international developed and 10 in emerging market
Okay.
stocks. Younger people would be higher as well, but that's where I am today. And again, I've got clients with only, 10% in the stock market, so they
Yeah.
would obviously have much lower.
But have some exposure. You're better diversified.
I really think right now this chart just shows these trends, but really when we look at the prices that you're paying to get a good company outside the US, it's actually a good time. It looks to me to be a good time to be investing. Again, I have no wizard hat or crystal ball any better than anyone else's, but
Yeah.
but having diversification, this is again diversification. If the US is raising rates, that doesn't impact uh, a UK company quite as much.
Yeah. Let's go to the next slide.
Yeah. And this is my don't pick stock slide. So what we find is that going out and buying, I'm a huge fan of index funds. So buying an index fund where you're buying stock, the whole range of stocks is a much better approach, in my opinion, than buying individual stocks. This particular chart is showing that more than 90% of professional stock pickers underperform basic index funds over any 10 and 20-year period. We can see this just bar here. When we compare them, 86% of all professionals underperform the index fund over a 10-year period and 90% over a 20-year period. And we don't know at the beginning of the 10-year period or the 20-year period who are the winners going to be. That's the hard part. Even if there are 10% winners, we don't know who they're going to be until the end of the race. And so it's very difficult. So who am I to think that I am the great next stock picker when 90% of professionals who live and breathe this stuff, who are paid the most to do it, who have teams, who have all the tools, who can call and talk to the leaders of these companies and know what's going on more than I ever will, how do I think that I'm going to beat the average professional? So I'd rather just own the index fund. And so one of my favorite lines is, don't try to find the needle in the haystack, buy the haystack. And so that's the index fund approach, is to own the haystack rather than the individual stocks. And you'll own Google and you'll own Amazon and you'll own all these great companies. and you'll own less of the ones that aren't doing as well. So indexing is a much better approach. This chart here, just the real high level, is that same dynamic applies if you're investing not only in large company stocks, right, where we saw that the 90% numbers, but we see in mid-sized companies, 92% underperform. If you're investing in small companies, 93% underperform. International, 90% perform. It is very difficult to beat the markets over time. And when we add risk adjusted, these dark blue lines are risk adjusted returns. Well, are they taking less risk? No, they're actually often not taking less risk. And then what it doesn't show here is the taxes as well. People that are trying to buy and sell and buy and sell to beat the markets also realize gains along the way, and you pay a lot more taxes in those than you would in an index fund. So index funds I'm a huge fan, obviously. Pete's favorite chart, I should have a drum roll here, his very favorite chart in the mix. And this is, you could sit back real quickly when you see all the blinginess here, but this is a chart showing the different asset classes and how they did in each calendar year. So if we look in 2009, we see that cash earned 0.1%, bonds earned 5.9%, commodities 18.9, all the way up to US large company stocks earned 26 that year, and emerging markets had a killer year in 2009. What we're not showing is the 2008, which was the global financial crisis, where all of these were down, double digits and more. So this is definitely a bounce back off the lows. And then we see the next year, REITs were the top. High yield, large cap is here, cash is at the bottom again. And then we see the trend here. So my favorite thing to say is, if you have this information and you look at it long enough, you see a clear trend. It's an amazing trend. And the trend is there is no trend. There's nothing here to help you figure this out. Actually, I spoke at a It's Your Money event last week, and someone said, well, what if I feed all this into an AI? Won't it tell me what to do in the next year? And I said, yes, it'll tell you what to do in the next year, but it's not right. It has no idea what it'll tell you how you should. We know how we should have invested in 2009 for all the next years, but we don't know looking forward. So if I take this chart and go out way here, we have no idea what these are going to look like, what are going to be the best and what will be the worst. 2 points. What do people invest in? They invest in the things that did the best after it did the best. So we're investing, oh my gosh, emerging market equities were up 79%. Let me go invest in that. Well, it's not the best the next year. And then it's the worst 2 years later. So don't follow the trend. That's a painful lesson. And then there's the lesson of, well, what if I'm the contrarian, I buy the worst? Well, you do okay, but not super great. What's the best? Is it better to be the follower? Better to be the strong stomach investor? Or is it better to own a little bit of everything? And guess what? It's better to own a little bit of everything here.
And that
So
asset allocation, Mark, was that in the white, what was that asset allocation?
yeah, 25% in large companies, 10% in
Oh,
small
okay.
companies, 15% a little bit. Essentially a 60-40 portfolio, but a
60,
little bit in
40.
each of these, essentially investing in a little bit of these.
Yeah.
Guess what?
Would
You're
you
never the
consider,
best. You're
would
never
you,
the best. You're never the worst, which is
okay.
great.
Would you consider a 60-40 portfolio to be a moderate risk portfolio?
I do. So if a starting point, if I know nothing about someone, a 60-40 is not a bad starting point for an investment portfolio. Obviously, older people that are drawing money every year that don't have strong stomachs shouldn't be in 60% in stocks. And people that are investing over time could have even a higher allocation than that. But 60-40 is a very good starting point for anyone.
Do people know when they first meet with you or when you first sit down with them as to what their risk of their portfolio is?
Exactly 0 people have I've ever met have ever done that and have known the risk in any way. So even my engineering clients, and I love my engineering clients, they'll have looked at it, but they're thinking about risk differently and may not know the whole history. So a lot of times people are just looking at the last 3 years as really that's their takeaway of
Mhm.
how they've done, rather than thinking about what this looks like over the historical standpoint. As we're seeing lots and lots of historical charts, I think that's really valuable.
Yeah. This chart, I love this chart because it basically tells you that no one can predict what's going to happen in the future.
Yeah, but lots of people will sell you the horse racing tips as well as the stock tips as well. So really understanding that I think is super important. The one thing that we will see is cash and bonds, right? The purple and the dark blue, they tend to be at the bottom, right? When the markets are up, then you're going to earn less in cash and bonds. We do see a lot of commodities down at the bottom. So commodities have been a horrible place to invest. And I've had people that have seen this slide to say, why don't we just exclude commodities entirely? Well, if I look back to the previous 20-year period, or yeah, almost that length of time, we see a lot of commodities looking really good. So even if we stretch this out, ignoring every single asset class, I'm not a huge commodity investor by any stretch, but excluding any of these really can, I think, having a well diversified, a little bit of everything makes sense. And I'll tell my chocolate chip recipe story real quickly. Is you can take all of the stuff that makes good chocolate chip cookies and put it all on your counter. And if you just throw it together, mix it, throw it in the oven, it's not going to make a good chocolate chip cookie. I can't say that word today.
Yeah, yeah,
So,
see, that's
yeah, exactly. I'm having a struggling. It's not going to make a good cookie at the end of the day. You have to have a little bit, you have to have the right proportions of things. And then you certainly can't have all the things there and you taste each ingredient and you say, oh, the sugar is great. The chocolate chips are great. So I'll just have a pile of those and no flour and no baking powder and make a good cookie. So you can't, sometimes you got to own things that aren't all that pleasant, are fixed income and cash, to make for a good portfolio at the end of the day, because they each have their little job to do.
and
But at the same time, there's 45 really good recipes for cookies, and there's 45 decent portfolio mixes. I'm not going to argue if you have, this says 25% in the large company stocks. What if you had 27 and I had only 8% in small company stocks? We're going to be in the same range here, right? So, and that's the equivalent of 2 tablespoons of nuts in the cookie versus not having 2 tablespoons of nuts. So
yeah.
there's a lot of ways to build it, but there's also ways not to build it. And having 80% in chocolate chips does not make for a good recipe. Having 80% in emerging markets doesn't make for a good portfolio.
So the first step is to figure out what you own, take a look at your own portfolio, see if you can put your classifications together of what percentages of stuff that you own at the present time, and analyze that first before you jump ahead and say, I need to make a change. Who knows what you have until it takes, I would say, somebody who is just starting out, it'll take you 3 to 5 hours to figure out all your percentages, but it's well worth your time to do so. If you don't like doing this stuff, see a financial advisor, a fee only financial advisor. Please don't go to a stockbroker or meet with a stockbroker and then go to a fee only advisor. Let's go to the next slide.
Yeah, and this is the last slide of the mix, and I'm happy to stick around for questions at the end for any specific questions. Um, my my investment professor, many years ago, he used to say the magic's in the mix, and that's a really good takeaway here. How you put it together is really important. And I would start with you can break it down that, Pete's saying 3 to 5 hours to break it down to know how much is in small companies and emerging markets and bonds and all that. That's a lot of work. I'd say even start here. And one of my favorite things is when you is that red dot. So when you go into a mall or you go into Disneyland, the first thing you do is you try to find a map, one of those big, huge maps, and there's a red. And what do you look at? You look for the red dot, right? And the red
Where
dot
am,
says you
where am
are
I?
here. You are here. You need to know where you are before you can get to anywhere that you want to go. So always start there. And I would say start here. This is the easier. This isn't the 5 to 6 hour version. This is the less than 1 hour version, hopefully, to figure out how much do you have in stocks and how much you have in bonds. And understanding that particular dynamic is super powerful, but also understanding that even if I'm 20% in stocks and 80% in bonds, which is pretty conservative, you lost money 16 out of the last 95 years. And so just having a good expectation there so that when these times happen, it's not so scary because oh, that's just the way it is. And it's like, it rains in Hawaii. You're not so upset if someone tells you that ahead of time and you have a rainy day in the middle of Hawaii. So having good expectations is such an important part of investing. And that's really the core of, besides those comments that Pete added as well. But
Look
it's
at the
80,
40%
20%.
60 mark. The that's only 19 years out of 95.
Correct. Yeah, we see, and these losses are lower, right? So this is showing a loss of 18%, but this year is 1931. This is the Great Depression, right? So things are very different. We had no FDIC protection. We had no Social Security. We have a lot more protections here. So the losses, but you can still, so understanding how many years of a loss, but also how big the loss can be is important. And then this also shows the average returns over that period of time. I would say temper these with some reason that this has been a very good 100-year period for both stocks and bonds. And that I would say expecting 7% out of a 20/80 portfolio is pretty optimistic from here. And expecting 10% from an 80/20 is pretty optimistic from here.
So
But
your expectation in a 60/40 portfolio going forward is right around 7% return?
yeah, I say 6 to 8 just because I don't want to pinpoint anything, but I would say, yeah, have it more in that range going forward. And if it's more, then my goal is always to call clients with good news. And so I always use conservative estimates on all this stuff so that we plan for the future, but we plan conservatively so that I'm calling with good news, not bad news along the way.
Yeah. Okay. Well, we've got about 5 minutes left, and I don't see any questions, which is absolutely amazing because normally we would. So that must attest to your great teaching skill,
Or
Mark.
the Z's going across the keyboard, one or the
Yeah.
other.
So I'm going to try to see if we can end this particular session for our live recorded session. Thank you so much, Mark, for
Okay.
participating. Next week, what we'll be doing is the financial planning 2 and putting the last 5 weeks together and uh, for the final session. So hopefully we'll see everyone on week 6.